Can the stock market keep going higher? Well, according to Warren Buffett, we are playing with fire. Does his Buffett indicator matter anymore? I'll explain that chart in just a moment. Or is it irrelevant? After all, after he retired, Berkshire Hathaway stock has declined over 10%, which is pretty sad because somewhat indicates a little bit of a lack of faith in Mr. Abel, if you will. You can see Berkshire Class B stock here down 10.3% since Buffett announced his departure. And to understand Buffett indicator, it's worth remembering what the components of the indicator are. So think about the Buffett indicator as, and it's not exactly a ratio, but it's almost a ratio. Think of it as a ratio between GDP and the stock market. So if GDP today in the United States is $30 trillion, which is where it is, how much do you think the stock market should be worth? 1 times that? 1.5 times that? 2 times that? Well, right now, it's worth a little bit more than 2 times. And that's approximately what the Buffett indicator looks like. So, we're sitting over here above the 2.2. Now this chart, don't get confused, just keep it simple. It refers to standard deviations from a historical trend. It just happens to roughly align with 2.2 times GDP. But if you look at a time like 2011, for example, you go over to the end of 2011, you get about a $16 trillion economy. How large do you think this US stock market was at that time? $16 trillion for GDP. And where were we in 2011? Well, we were probably right about here. So we would have been trading around these levels of about $17-18 trillion. And in this case, it shows slightly under that 0 times. So a little bit confusing. And how do we know that? Because we look over here at the stock market chart and we could see in 2011, we're trading somewhere on, oh wait, look at this. In 2011, it actually came down again a little bit. Ooh, that's juicy. Look at that. Yeah, so about 1-to-1 in 2011, actually. So about 1-to-1 in 2011, which should be right aligned with that 0 there. So close enough. It's close enough to say that roughly the stock market Buffett indicator is just a multiple of how much we want to pay of our GDP. So right now we're paying 2 times the gross domestic product of the United States for the stock market. In 2011, we were only paying 1 time. And in 2008, during the depth of the financial crisis, we were paying, let's see, 11.4. Depth of the financial crisis was over here. We were paying a discount, 11.4 divided by 14.3. We were paying about 80 cents on the dollar for our stock market in the depths of the 2008 recession, which is kind of interesting if you think about it. Like it's a good chart. It sort of shows us, oh, okay, all right, this is an easy way to understand the Buffett indicator. It's just a multiple of how much of GDP are we willing to pay. Well, obviously, we are at the top of that level right now. We came down during Liberation Day, which is worth paying attention to here. So if we just zoom in here for a moment, this little bitty spiky right here, that V shape right there, that was basically your 2-week Liberation Day. And if you align a down arrow right here with Liberation Day, you can see what a recession feels like by following this red arrow down on the sort of purple line here, all the way down. That's what a recession feels like. And so there are a lot of people that say, wait a minute, Kevin, how could there be a recession that bad? There are so many retail traders these days. This time is different. And, everybody can just buy the dip on Robinhood. We're never going to have a dip again. There'll never be a recession again because Jay Powell will just bail us out. All right, well, so far we're already conflating 2 things, right? 1 is retail owning stocks. 2 is the Fed bailing us out. Let's talk about both of those. First, let's go over here. I pasted this chart onto here. This is the US stock ownership annual trends. And what you could see since 1998, this is from Gallup polls, since 1998, I'll get the non-blurry version. the percentage of people who have owned stocks or households that have owned stocks in our US stock market has basically sat entirely stable. Now, people don't like to hear that because people are like, wait a minute, Kevin, but how is that possible if so many people use Robinhood now? So I have a thesis on this because I too think it's odd that in 1998, 60% of households had exposure to stocks, individual stocks, mutual funds, or 401ks or individual retirement accounts. And today, 62% of households own stocks. Mind you, most of these people are higher income individuals are more likely to own stocks. More educated people are more likely to own stocks. Whiter people are more likely to own stocks. I guess whiter isn't the word. I guess white people are more likely to own stocks as opposed to black people or Hispanic or whatever, right? And then married individuals are more likely to own stocks. Interesting sort of demo here from Gallup polls. But what's fascinating here is you don't actually see a greater percentage of households owning stocks. The percentage did go down after the 2008 financial crisis, down to about 52%. But we're really just back to where we were in the dot-com bubble era. How does this reconcile with everybody, though, using like Robinhood or all these self-directed stock apps? Well, in my opinion, the reason we have the same number or percentage of households owning stocks is because people who own stocks today are just more likely to own individual stocks or ETFs directly. So if you want to buy an ETF, why pay a financial advisor 100 basis points if you could just go pay Vanguard 7 and go buy the S&P 500? You could just do it yourself on Vanguard or on Robinhood or whatever. Like, you don't have to go buy a stock market mutual fund that has load fees and all these complicated, nonsensical things, and you don't have to call an advisor to buy or sell or email in your crap or whatever. You just swipe up on Robinhood. So I think a lot of money has gone from these more friction-based mutual fund products to ETFs and brokerages, which means we don't actually have a greater percentage of Americans owning stocks today. Now, we do know that the people who own stocks today have more money than they did previously because of just inflation, over time stock market growth, valuation growth, asset price appreciation. So yes, retail flows look higher. But again, in my opinion, that's because you're taking from institutional funds, from mutual funds, and you're giving to retail. Now, that could come with some potential consequences. In my opinion, retail owning more stocks, it's great because fees are lower, but it does potentially induce more volatility. I think this retail volatility that we got here during Liberation, when data had not really changed, was really a sign of panic. And we saw within 2 weeks how quickly we fell. And the effects of these tariffs won't really be felt for 6 months to a year after they're fully imposed. And the real recessionary impacts usually come once jobs actually start weakening, but by then it's usually too late. And so I do wonder how rapidly, if basically as rapidly as people are buying now, how rapidly people are just going to dump stocks in that next recession. And I hope it's 10 years out or whatever, because just because we're high on this chart does not mean we have to collapse. It just means we're a little restricted with how high we can go based on this chart. So the last time we were this high was really over here. And this would have been the 1950s to 60s, so late 50s to late 60s. And what happened here was a post-war boom. You had a massive housing construction boom. You had a baby boom, so familial expansion. And you had relative peace and stability with no longer a wartime economy, but rather a consumer-led economy and an entertainment and services-led economy, which is great for GDP growth. So we should look at what GDP did between 58 and 68. But the markets were very much in this sort of overvalued level here for 11 years. Now, they never got past the levels where we sit today. We pretty much always top out here. So there are two ways for stocks to keep going higher. Well, really there's only one way according to this chart, but there are two ways practically. One way is GDP goes up. So every dollar GDP goes up, our stock market is willing to go up, let's say $2. That could keep this chart going. And maybe it ends up running to where we start seeing people being willing to pay $2.50 or $3 for the stock market. I suppose that could happen. It would be in the strongly overvalued category per Buffett. Who knows? Maybe this time is different, right? But historically, we never get past this. So GDP growth could get us to do this, or, which is one way, or the second way is we stop caring about this top and markets are just willing to pay a higher premium, which I suppose is possible but doesn't have a historical precedent. Now, this doesn't necessarily mean that the market has to crash, because remember, we sat in this level for 11 years. Now, we did bob up and down. We generally don't sit at that red dotted line for a very long time. We didn't sit at that dotted line for more than 6 months over here, more than a month over here, more than a month over here, more than a month over here, more than 6 months over here, more than, a month or two over here, and now we're in that sort of month or two period again at sort of peak. Like I say, times could be different, but understand one of the downsides we face right now is that GDP growth is really beginning to slow. So if we go to percent change from a year ago, we could really see GDP growth fall. Now, this is non-inflation adjusted. So understand when you see this 4.6% is non-inflation adjusted, what we could really do is we could actually just type in St. Louis Fred real GDP, and it'll give us a little bit of a better view of this because it will adjust for inflation, which is the GDP number that we use anyway. We go percent from a year ago, and we can see right now GDP is rolling over. It's expected to only be about 1.5% at, basically the end of next year. So that makes it a little harder to keep pushing all-time highs. But again, it doesn't imply that people's willingness to pay this multiplier, this $62 trillion for the stock market, doesn't necessarily have to disappear, which is fascinating. So putting some of the other items of this together over here, it's also worth looking at this chart right here. Why were we so low during this period of time? In my opinion, this is actually when the Federal Reserve lost its credibility in this box right here. This is when we ended up having price controls over here. Price controls were lifted. The Fed lost control of inflation. We left the gold standard. We had an oil price crisis. We had an inflationary shock. We had Arthur Burns, who was way too reactive to what was going on in the economy, much like what Trump is demanding of Powell today. And you ended up with a Fed with no credibility. You ended up having a double dip recession in the 80s, which then took 5 years for the Fed to really gain respect and to get out of this it's mostly undervalued to slightly fairly valued market. And then you had 40 years of disinflation with falling inflation, and valuations actually just grew during this period on net, with the exception of obviously the crashes that we saw during the dot-com bubble, which was the crash right here, and the Great Recession over here. Somebody else made an interesting note that you don't necessarily have to have a recession off the top, that you could have a recession off the middle. See, valuations never actually bubbled up like they did in the internet bubble in 2008. Valuations were actually still recovering, and we fell down. So that's where, it's just worth thinking about this chart. Hopefully it doesn't get a crash. Technically, it doesn't say we have to crash. It just says in order for us to really charge higher here, we need GDP to grow. And maybe that's why we're seeing a little bit of this resistance. Look at, for example, ServiceNow. Oops, that's Snowflake. So ServiceNow just had exceptional earnings, really good earnings. And the stock popped on earnings, but just couldn't make it ahead. You've got another big IBM company, or American company, IBM, falls after earnings. You've got Netflix after disappointing earnings. Netflix had great earnings. Also been on a downtrend here on the day chart, and certainly since earnings, it's been rolling over. Look at a company like Intel. I mean, they've had many idiosyncratic issues, you know, their own problems basically. And I mean, perfect reject off the meet Kevin line here and straight down. So, you know, maybe all of this together just suggests that at some point this uptrend that we're curving on right now for the Qs, following this recovery from liberation, you know, maybe we do start hitting our head on sort of some glass ceiling because there is concern around, hey, we need to see GDP growth. So far, the next GDP estimates we're going to get, though, are kind of misleading because Q1 GDP had the lack of imports due to tariffs, this surge of imports due to tariff front running, which tanked our GDP. Then you had less front running, which boosted our GDP in Q2. So Q2 GDP looks totally fine at 2.4%, but GDP in Q1 was negative 0.3%. So averaged out, you're really at like, you know, what? I mean, negative 0.3 to the negative plus 2.4 divided by 2. You're really at an average of 1.05% GDP. So if Q3 GDP comes in at 1% as well, that's slow. And it just limits your ability on that Buffett indicator to keep moving up, unless, of course, this time is different.
Kevin's somebody we'd consider. Kevin is fantastic.
Kevin is very talented, but I don't know if it's going to be him, but he's a very talented guy.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.